Good afternoon. Welcome to the Sykes & Company PA webinar, Tax Strategies for a New Environment. This webinar will be recorded and will be sent out to all attendees. Please be sure to add your questions in the question box at any point during the webinar. We will be answering them at the end of the webinar. I would like to introduce the two speakers, Ollin Sykes and Scotty Sykes. Ollin Sykes is involved in all aspects of the business with a concentration in tax, business advisory services, and technology consulting for independent pharmacies and their owners. He got his start as a CPA in 1973, and within a few years began working with independent pharmacies. He became president of Sykes & Company PA in 1985 when the firm started. He is a frequent speaker at many conferences as well as a published author of many accounting and pharmacy industry articles. Scotty Sykes began his career at Sykes & Company PA, shredding paper in the 1990s. Since then, his focus has shifted to help lead the company forward through building strong relationships with pharmacy owners, third parties, and key vendors to enable pharmacy clients to have access to the best possible resources, accounting, tax, and advisory in the pharmacy industry. He is actively involved in all areas of pharmacy accounting and tax with the emphasis on high-level advisory for pharmacy clients. Scotty is a frequent contributor within the community pharmacy industry and presents on pharmacy accounting and complex tax matters. He is also an avid writer, providing a progressive approach to operating a successful pharmacy. He has published several pharmacy accounting and tax-related articles in industry publications. In addition, both Ollin and Scotty produce videos addressing accounting and tax-related issues facing pharmacies today. These are available on the website at www.sykes-cpa.com. With that, I will pass it on to Scotty and Ollin.
Thank you very much, Dawn. We appreciate everyone in attendance today. I'm Ollin Sykes, and as Dawn has mentioned, we're very much involved in working with pharmacies. In fact, that's our only focus here. We work with hundreds of pharmacies all over the country. We're some 45 people internally. We provide cloud-based accounting, tax mitigation, and tax planning services for pharmacies only. As Dawn had mentioned, we update the website through videos constantly. And with that said, we want to get right into our topic today, and I'm going to turn it over to Scotty in a few minutes. And I encourage you to put your questions in as you come to them. We'll try to answer them perhaps as we go through, depending on how they flow into the conversation. We'll clearly get to them at the end. So with that said, Scotty, go ahead.
Okay. Let's go ahead and get started here. All right. With table of contents today, we're going to talk about the Tax Cuts and Jobs Act. We're going to go over some individual highlights, the business highlights. We're going to touch on the cash method of accounting, Section 199A, the QBI deduction. We're going to spend a lot of time on the cash method in 199A today. We're going to go over some tax planning tips, and we're not going to be going over the example. We will be doing examples during the webinar, but we're not going to go over the comprehensive example in this webinar due to the time constraints. Oh, getting ahead of myself. Okay. First major tax reform in over 30 years is the Tax Cuts and Jobs Act of 2017. So major changes here impacting just about every taxpayer out there. It's going to impact you. It's going to impact the pharmacy owner. A lot of these changes start in 2018. And one key thing to consider, a lot of these provisions expire after 2025 unless Congress does something at that time. These provisions will expire, most of them, if Congress does not act. Revenue Procedure 2018-40 deals with the cash method of accounting. That was guidance that was released in August. We're going to be going over that in detail. And Proposed Regulation 199A was also released in August, and we're going to be going over that as well. So let's go over some quick individual highlights. There's 7 tax brackets, the same as previous tax law. However, the brackets have decreased pretty much across the board. So you are seeing a tax rate reduction there. No more dependent exemptions. However, there is an increase in the standard deduction. It's gone up to $24,000, the standard deduction for married filing joint. Many taxpayers are going to be doing the standard deduction this year. And so instead of counting all those medical bills and determining whether you're going to be able to take that, you might not need to do that this year. The standard deduction is going to be in excess of any itemized deductions in a lot of cases this year. The higher child tax credit's $2,000, and some of that is refundable. I believe it's $1,500 of that is refundable. AMT tax, alternative minimum tax, has not been repealed for individuals, but its exemptions and phase outs have increased. So a lot of taxpayers will not fall under the AMT for 2018. There's been some changes in the net operating losses. Traditionally, you could carry those back. That has been repealed. You can only carry those forward, and there's limitations on that carry forward. Itemized deductions, we got the repeal of the overall limitation on these itemized deductions. If you look at prior year Schedule A, your itemized deduction schedule on your tax return, you're going to see on the bottom a limitation on those deductions that has been repealed. The medical deduction now is 7.5% of your adjusted gross income. It's going to increase to 10% starting in 2019. There's been some changes in mortgage and home equity interest. There's some limitations there. You just need to be aware that any home equity that you're taking from the home, from the equity in your home, if you're not spending that money on improvements inside your home and you're using it for other purposes, it may not be deductible. So there are some changes in the mortgage and home equity interest limitations. The state local real estate tax deductions limited to $10,000. And this is one you hear in the news a lot, is the SALT tax. Those high tax states, New York, Connecticut, New Jersey, California, they have, of course, talked about how they do not like this area of the tax law. So essentially, this is going to impact a whole lot of taxpayers, especially the higher income taxpayers that pay a lot of state tax. You're only limited to, you're only allowed $10,000 this year in deduction for the state taxes. So this right here will also push a lot of people into that standard deduction increase this year. So expect the SALT tax here to be litigated and talked about in many years to come. The 2% miscellaneous itemized deductions portion of your Schedule A has been completely repealed, and is anything there is no longer deductible, including any home office expenses, those investment advisory fees as well. Charity limitations have increased to 60% of adjusted gross income. It was previously 50%, so they've increased it to 60% of your adjusted gross income. Okay, business highlights.
Okay, there's been a change in the C corporation tax rate. This is much publicized change in the law. There's a flat rate now of 21%, effective 12/31/17. If you have, let's say, a 9/30/18 year end, then you'll have 3/4 of the year taxed at 21%, and the first quarter of last year, which is the October through December quarter, taxed at the previous tax rate. A lot of people are thinking that the S to C tax structure, there's a lot of consideration there about what status is best for pharmacists. Frankly, we prefer the S corporation status. That can be either an S corporation by itself or an LLC taxed as an S corporation. Any change that you potentially make from a C to an S status needs to be very carefully planned out, because there's all types of potential tax ramifications on that. So that's something you don't want to just change without doing a complete detailed analysis on that. The corporate AMT tax, alternative minimum tax, has been repealed. There's been some changes in non-operating losses as far as corporations are concerned. And next slide. The domestic production activity deduction, which applies to many compounders. Those of you that, let's say, do more than 10% in compounding have been allowed for the last number of years a deduction from your gross income, which can be substantial. That's been repealed as a 1/1/18. We put this slide in here because we're still finding compounders who know nothing about this, and you still have 17 and 16 tax years that can be amended. Potentially, if you've had substantial compounding back in those previous years, we just want to bring that to your attention. But again, it's repealed 1/1/18.
Okay, the research and development credit, this has not been changed at all. under the Tax Cuts and Jobs Act. So this just stays the same as it was previously. This is potentially an applicable credit to compounders who are creating new formularies, improving certain prescriptions, or doing some research, et cetera, to create a new compound or a new drug, et cetera. It's a 4-step process to ensure you're eligible to take this credit, which can be quite lengthy. And if you haven't taken this in previous years, just like the domestic production activities deduction on the previous slide, you may be able to go back and recoup some taxes here. But if you are you're compounding and you're creating new products and improving products, this might be something that's applicable to you. Okay, meals and entertainment. First and foremost, with any of these meals and entertainment expenses that you're taking, you need to understand that documentation is required under any IRS audits. The first thing they're going to ask for when looking at meals and entertainment is documentation. So you need to make sure you have pretty much the who, what, when, where, how documentation of that expense. Entertainment expenses have been repealed. If you take a vendor or your supplier out to the football game to just talk whatever business or whatever, that has been repealed. That's no longer allowed to be expensed. If you have any holiday office parties, maybe a summer picnic where all staff are invited, that's 100% deductible. Let's see, meals for employees on the road for work and for the convenience of the employee are 50% deductible. So if you're on the road going to a trade show with a couple of your staff and you got to eat, obviously you have to eat dinner out there, that's going to be a 50% expense there, deductible expense. There's a gray area in the law that's not clear, and that is meals with vendors, suppliers, to build relationships, etc. So if you take that doctor to dinner to build that relationship, to let them know about your pharmacy, to let them know about what you do and why you're different, there's a gray area in the law as to whether that's going to be 50% deductible or just non-deductible as an entertainment expense. We are waiting on guidance on this area, but we have not seen that guidance yet. But this meals and entertainment change has impacted not just pharmacy, all industries pretty much. So we do expect a lot of pushback from taxpayers to Congress on this and some changes, maybe in that tax reform 2.0 that's been floating around out there. But who knows? We'll just have to wait and see.
And just as a reminder, a credit card charge is not documentation. There's a lot of apps that are out there. I know I personally use an Amex app that allows me to take a picture of a credit card charge, write a brief note literally on my iPhone, record that, tag it to the photo of the meal that perhaps I'm having with our staff member. For example, we're going to the NCPA convention, and that type of thing a lot of expenses can be documented in that particular way. But as Scotty mentioned, the who, what, when, and where is extraordinarily important. Keeping in mind that if you're audited, in addition to wanting to see documentation, especially from 2% or greater shareholders, they're going to want to see your minutes of the entity, if it's a corporation, and they're going to want to see mileage documentation for your vehicles. And your mileage documentation in vehicles can be easily tracked now with apps. I know I personally use a new app called Mile IQ. That's MILE-IQ. It's a Microsoft product that actually automatically records my trips and then lets me come in a later time and put the documentation in, whether it's business or personal, and write a particular note to take care of the documentation needs. So documentation is the key here.
Yeah, and technology is going to help you be able to keep that documentation pretty easily. Okay, Section 263A UNICAP. This is essentially a tax increase for larger pharmacies. It's been in the law quite some time. Prior to Tax Cuts and Jobs Act, it applied to pharmacies, including controlled groups. A controlled group is any pharmacy owner who owns maybe several pharmacies and has a control in those pharmacies. So it applied to those pharmacies with revenues greater than 10 million. So if you are a controlled group, you take the average of revenues for all your pharmacies, and if it was greater than 10 million, you were applicable here for 263A UNICAP. Now the change in Tax Cuts and Jobs Act, it has now increased from 10 million to 25 million. So this is a major relief to the taxpayer. It is a very complex set of rules and calculations, so it's also a big relief to the CPA as well. But many pharmacies we found were non-compliant in this area, but thankfully under Tax Cuts and Jobs Act, this has been expanded, so many pharmacies will be kicked out here. Okay, depreciation. In summary, pretty much any capital improvements you're putting into a pharmacy in most cases are going to be able to write off the whole entire amount if it's put in use in this tax year. So bonus depreciation is going to allow 100% write-off in 2018. Same with Section 179, 100% write-off. Whether you choose your CPA chooses bonus or Section 179 is going to depend on several factors, but including state add back. Some states don't follow the federal rules here. But it applies to new and used assets, and it has to be placed in service this year. So if you're looking to purchase that robot, you need to make sure that you've purchased it and that it's put in use by December 31st, and you're able to run a script through that robot by the end of the year to make sure it's placed in service. And multi-year planning is suggested, especially when you're looking at states and how they handle the depreciation limitations.
Also, I might mention that a lot of capital leases are employed now with technology in the pharmacy arena. Most of the robotic companies offer leases. Some of the script management companies for script systems do the same thing in point of sale systems. A capital lease is where maybe you would pay the first and last payment up front. You might pay $1 at the end of the lease. It may be a 3, 4, or 5 year term. That would be considered a capital lease or a financing lease, and that would be as if you bought the equipment in year one. And again, as long as you put it in use on it before December 31st, for all intents and purposes, you can write off the entire asset in a year that you put it into use.
Yep, and I'll also mention one other thing. Some improvements inside your pharmacy, leasehold improvements, also apply for these these depreciation write-offs. So make sure that you are aware that any improvements that you're making inside your pharmacy are handled correctly.
And while you mention this, Scotty, let me just briefly mention, if you have made major expansions with your pharmacy structures and buildings in the last few years, and if you've not what's called cost segregated the asset improvements, which essentially breaks down the component parts of those improvements to the facilities in very detailed parts to allow you to dramatically write those properties off or those assets off in a short period of time. That's something you can do retroactively back for many, many years. Many people are missing this option. There's a lot of details involved with this, but there's a lot of opportunities to dramatically increase your depreciation, and you can literally go back and make a one-time type of adjustment all at one time. So that is something you definitely want to take a look at. Again, it's called cost segregation if you're involved in any kind of major improvements. We had an $800,000 pharmacy, for example, not including land, that about 53% of it was written off over the first 5 years, as an example. So that's a very common type of thing we would see.
Major tax planning tool there, and also you can go back and implement a cost segregation study for previous years.
Correct.
And recoup some tax you've paid previously. So there are some great opportunities with cost segregation. Delivery vehicles increase in first year depreciation to $10,000 from $3,100 there. The 1031 exchange of vehicles has been repealed. So if you trade in your old delivery vehicle for a new one, when you make that trade in, the gain or loss on that trade is going to be recognized in the year. There's no more deferring of that gain or loss. Planning opportunities for vehicles over 6,000 pounds. For vehicles over 6,000 pounds, there's enhanced depreciation, which we just talked about, the bonus depreciation, Section 179. You can essentially write off 100% of that business vehicle if it's 100% business use and it's over 6,000 pounds. So if you're in the need for a new delivery vehicle and maybe a truck would fit your needs in this case, and it's over 6,000 pounds, you may be able to use some very favorable depreciation strategies there to write that truck off. Again, documentation's required. Very important. The IRS is going to ask for that IRS or for that documentation, so you need to be able to provide that information. Okay, the cash method of accounting. This is one of the bigger issues impacting pharmacy in 2018 out of tax reform. It's quite complex. We might get a little technical on a little of these things, but do know this is a big major change, and you're going to have to do some tax planning to determine whether this is a good fit for you or not. And so let's just dive right in here. Again, a major fundamental change to the tax code here. It is taxpayer friendly. It's going to impact your financial reporting if you implement the cash method accounting. And the IRS Revenue Procedure 2018-40 has more on this section here. So prior to the Tax Cuts and Jobs Act, so what were the rules prior to the tax reform? The rules were generally pharmacies were required to report accrual basis accounting for tax purposes. Many pharmacies did not do that correctly, so these changes may not really apply to you. It just depends on your current situation. But we did find that when we were looking at prior year tax returns for pharmacies that were having us overview their information, we saw that a lot of pharmacies were not in compliance with the accrual basis accounting method. But after tax reform here, the IRS has expanded the use of the cash method of accounting for tax reporting. This is available for pharmacies with revenues less than 25 million in gross receipts for the prior 3 years. Again, that controlled group situation also applies here. So if you're a pharmacy owner that owns 3 pharmacies, you're going to take the total gross receipts for all 3 pharmacies, take that average, and if it's over 25 million, you're not allowed to use the cash method. So keep that in mind. Going back to the cash accounting method before we get into inventory here. Under the accrual method of accounting, you're going to be reporting third-party insurance receivables. So the money owed to you from the third-party insurance companies, that is going to be recognized as income when you adjudicate that script. Under the accrual basis of accounting, you're going to be recognizing accounts payable, monies you owe vendors that you have not paid yet. Whereas on the other end, cash method, you will not recognize that income from third parties until you receive the money, and you're not going to recognize that expense until you pay the expense, pay that vendor. So that's the difference there. And when you go from an accrual basis to a cash basis, there's an adjustment, which we're going to talk about here in a minute. But that's kind of the difference in the 2 methods. Now, the cash method of accounting for inventory. If you decide to use the cash method accounting allowed under the Tax Cuts and Jobs Act, you must continue to use an accounting method for inventories that either treats it as non-incidental materials and supplies. You're going to be treating inventory as non-incidental materials and supplies, or you're going to conform to the taxpayer's financial accounting treatment. Treating inventory as non-incidental materials and supplies is essentially the same thing as keeping inventory on the books and keeping the corresponding payable, et cetera, on the books for that inventory. So there's really no major change there. The non-incidental materials and supplies can only be deducted when consumed or used in business, which would mean filling that script. Essentially the same thing under the accrual basis. Okay, before we get into the 3115 though, there has been some discussion out there about whether you can take a expense inventory up to $2,500. And the tax code, from what we've been able to see, just does not support taking a stance like this with the IRS. So I would be cautious before you take that route. Make sure you've spoken with your tax advisors, that you know the support, you know the citations in the tax code for why you're taking a stance like that. But generally speaking, non-incidental materials and supplies under the IRS tax code has always been considered inventory. Inventory is not eligible for the de minimis safe harbor election, which is the $2,500 expensing. So just be cautious as you hear those comments on
Scotty,
the
a question
screen.
that just came in applies just directly to this, is that they said they switched from cash to accrual several years back. Should we switch back to cash? The important thing we didn't mention is this is optional. This is not required. Whether you switch back from accrual to cash after going from accrual to cash, actually going from cash to accrual years back, is something you've got to really analyze internally to see what differentials it makes, how it impacts the qualified and the section 199A deduction, which we'll talk about in a few minutes. There's just a lot of factors here, so it's not a yes or no type of question. But generally speaking, from what we're seeing, it's obviously going to have a major impact, because if you think about it, your receivables may be $200,000, $300,000, $400,000, $500,000, $600,000 in a store. Your payables may be 200,000 or 300,000, 400,000. So there's going to be typically less payables than there are receivables. So that if there's $300,000 more receivables than there are payables for inventory, that adjustment comes off all at one time, and can be a very substantial decrease in your taxable income for the current year. And as you'll hear in a few minutes, taxable income, what that number is this year is very important. So just want to mention that.
Right. So if you got third-party receivables, $500,000, and the payables and liabilities accrual items are only $100,000, that net number is going to be $400,000, and that's an expense on the books for the current year. So $400,000 expense is going to wipe out a lot of income, may even push you down into a net loss. Whether you can take that loss on your tax return, whether you should do that or not, is another question. You have to run these numbers. You can't just say, I want to switch to the cash method. For example, I was just working on a tax plan here previously, and I ran the numbers between accrual and cash. And if he's looking to sell next year, sell the stock, it doesn't make sense for him to go to the cash method accounting. So I was looking at 2 years in conjunction with the change like this. So you have to really run the numbers and make sure this is the right thing to do. Now, if you do decide to make the change to cash accounting, you do a Form 3115 change in accounting. Luckily, the IRS has made this much easier for the taxpayer with all these changes that took place with Tax Cuts and Jobs Act. That $400,000 expense we were just talking about in that last example is called a 481A adjustment, and it is taken in the year of change if negative, if it's an expense. If for some reason you've got a different situation and it's positive, that 481 adjustment can be taken in year one if it's under $50,000, which is going to be income, or over a 4-year period if greater than $50,000. The Form 3115 is a complex form, but they've made it a lot easier.
Yeah, and one of the questions here about the 25 million, that's the 25 million threshold is the average of revenues for the last 3 years. So for 18 to be 17, 16, 15, the average revenue, if it's less than 25 million in the aggregate, again, if you have multiple pharmacies with essentially the same or similar ownership, then if it's less than 25 million, this can apply to you. So this is going to affect many pharmacies that are multiple, that have multiple operations, and typically most of our pharmacies have more than one location.
Yes, the 25 million is what they call a gross receipts test. It's the prior 3-year average gross revenues. It's called the gross receipts test. A couple other questions here. If you were previously on the cash method incorrectly, you should have been accrual. Is there anything you need to do? You'll need to talk to your advisors on that. Now that you're allowed to do cash method, that's going to be something you'll have to discuss and figure out depending on your situation. I think we've covered that. Okay.
Yeah, we did.
Well, the overview. So control groups, again, those control groups of ownership must be considered for the gross receipts tests. You've got an issue with cash basis tax and your books. So the IRS says that you can use the cash basis accounting method for tax purposes, but you need to be consistent with it in your books. So the books and tax need to be consistent, need to conform. And that presents an issue because cash method financial statements are not clear, or not a reality for what's taking place in a pharmacy. So many items in a pharmacy, such as the balance sheet and P&L, are accrual basis items, such as the third-party receivables, the payables, etc., that you can really skew the financial statements if you're not picking up everything on an accrual basis. If you're just doing cash, you're going to be limiting yourself. So that presents an issue when doing your books as well. There are ways around that, but it's extra steps and it's going to be more work. But there are issues there. Do understand that. And again, if you are already on the cash basis previously, and you're going to stick to the cash basis, there's just going to be no benefit for you. Okay, the Section 199 QBI deduction. This is the hot item number 2 on the list, and the QBI deduction is so qualified trade or businesses are entitled to a deduction equal to 20% of your qualified business income. This area can be extremely complex. I can't even begin to tell you how complex this area is. The tax law did not make this any easier at all. I can tell you it's going to get a little technical here as we go through these examples. But no, this is an complex area. The IRS issued IRS proposed regulation 1.199A. This is a proposed regulation. The IRS is accepting comments to these proposed regulations up until October 1st. We, Sykes & Company, have written comments to the IRS on our comments, which we're going to talk about here in a little bit. If you go to regulation.gov, type in 199A, you should be able to go in there and write some comments on what you think about this proposed regulation, and we'll be going over what we've made here shortly. So the eligible entities are sole proprietors, like the Schedule C entities, LLCs, partnerships, S corporations. Some rental property entities are also allowed the 199A. C corporations are not allowed 199A. The C corporations got the flat 21%. This 199A is to help all these other eligible entities up here get that tax rate closer to that C corp.
Yeah, it's an attempt to bring the tax rate down to about 29% from about 37. Obviously, the C corp rate is 21, but you got double taxation with C corp, so it's an attempt to bring that top rate down.
Yes,
they just didn't take it all the way.
That's right. Okay, qualified business income. That's essentially going to be the net trade or business income from the pharmacy. So if you got some gain or loss on maybe some assets you sold, that is not taken into consideration here. Your compensation, the owner compensation, any guaranteed payments, if you're a partnership, do decrease your QBI. So you need to understand in doing your planning, as you're pulling all these pieces together, whether you need to increase your salary, whether you need to be decreasing your salary to maximize the QBI deduction. Of course, you have to. The IRS says that that salary must be reasonable, so you can't take a $20,000 salary, report high QBI, and get a big deduction. The IRS says that salary has to be reasonable. A reasonable salary in many cases is going to be, the IRS is going to say, okay, what is the average pharmacist salary? And around $120,000, they're going to say, well, let's start there and go from there. So just make sure it's reasonable, and when you do your planning here, when determining your salary. Okay, so what is a qualified trade or business? It's going to be every single business except a W-2 employee. If you're a W-2 employee, you're not in a business, you do not get 199A. The second one is a specified service trade or business. We're going to call that an SSTB. If you are an SSTB, you are not you're not eligible for the 199A deduction if you are over certain thresholds, which we're going to talk about. So an SSTB is any, as it applies to pharmacy, is any trade or business involved in the performance of the services of health. So In the law, it says an SSTB is any business involved in the performances of services in the field of health. Okay, so what does health mean? I'm going to skip that. Health is defined as performance of services in the field of health means the provision of medical services by pharmacists who provide medical services directly to a patient. We skip down there to the bottom. So they're saying a pharmacist that is providing medical services directly to a patient is a health service, therefore is a specified service trade or business, SSTB, and if you're over the thresholds, you're not allowed 199A.
And an example of that would be clinical services, MTMs, immunizations. But again, we'll talk about there's a de minimis. If your revenues are less than 10% for that type of thing, it'll be excluded. But that would be a typical provision of medical services by pharmacists.
That, as we understand it,
Yes.
the tax law, this is all this is the definition here of in the tax law. So you tell me what a pharmacist who's providing services directly to a patient. Obviously, in our minds, inoculations, that kind of thing, would be a service here and not eligible. Okay, but as we continue, it clearly says that we're going to move on to the next. As we continue through that section of the law, this is the same paragraph. For example, the performance of services in the field of health does not include sale of pharmaceuticals or medical devices. So this exclusion paragraph says that sales of pharmaceuticals or medical devices is not an SSTB, and you are eligible for 199A across the board. So you got one paragraph that says if you're a pharmacist, you're a specified service trade or business, and then there's another paragraph that says if you're selling pharmaceuticals or medical devices, you're not a SSTB. I called the IRS authors of this section here we're looking at today.
The National Tax Office, the actual authors of this provision.
I did, and I asked them, you know, a retail pharmacy, would that be included in this definition here, sales of pharmaceuticals or medical devices? And they told me yes. Now, this was word of mouth that I was told on the phone, and it's not in writing, so there's no telling what the IRS ends up doing here. But that's...
To be clear, tell them, repeat that one more time. Yes, with respect to what?
Yes, a pharmacy would be considered sales of a retail pharmacy would be considered sales of pharmaceuticals or medical devices.
Correct.
DME.
Therefore, our firm's approach, until we see and or hear anything further from the National Tax Office, is just that a pharmacy, a typical retail pharmacy that less than 10% is in immunizations, MTM, clinical services, will be eligible for this deduction. And Troy, that I think I see your name on this call. I know we've talked that we've gotten further information since you and I last talked several weeks ago.
Yes, and so if you're going to make comments to the IRS on this issue, we've worked with the NCPA to coordinate our comments. Our comments were, A, please add comma retail pharmacy, including retail pharmacies at the end of this sentence. Sale of pharmaceuticals or medical devices, comma, including retail pharmacy. So we're asking them to specifically exclude pharmacy here as a health service. And then the second point, we asked the IRS, please define when a pharmacist here would be considered in the field of health performing a service.
And our view there, this is our view, is that if I'm a pharmacist and I have let's say I'm hiring on a contract basis, independent pharmacists to go in and work on a part-time basis at various pharmacies, that's a service in the field of health that we believe would not qualify for this deduction, to be clear. But that's kind of an exception rather than a rule, obviously. But we do see a fair number of that.
Mm-hmm. And so if you do a lot, say 5% of your revenues inoculations of service by a pharmacist, that would meet this definition we're looking at here. There's a de minimis rule that says if 10% or less of the revenue is from this service, say the inoculations, then it's not considered as part of the calculation. So a pharmacy with 95% retail, 5% inoculations with the de minimis rule would qualify all of it.
Yep.
So
For
keep
the
that in
deduction.
mind. There's no breaking out the company. You heard previously when this first was released that, hey, we might have to spin off our our inoculations and spin off our pharmacy into two separate entities. That's not the case with the de minimis rule. Okay, there's a question. The 25 million gross receipts for prior 3 years. It's yearly, so you don't take that combined over 3 years. It's yearly. Okay. All right, so how does this work? There's a general rule, which if you are in SSTB, you're allowed the general rule. There's a phase-in deduction. If you're an SSTB and you fall into this phase-in, you're allowed the phase-in deduction. If you're over the thresholds and you fall into the limited deduction and you're an SSTB, you get the 199A is out the door. It's determined separately for each qualified trade or business.
And we've got a question here. What about long-term care pharmacies and compounding pharmacies? We believe that would qualify based on what we had just stated. Long-term care pharmacies or compounding, we believe that would qualify for the deduction.
As far as we know at this point, that's correct. The general rule, so you're getting a full 20% deduction if your taxable income is less than $315,000 for married, filing joint. Again, even if it is an SSTB business, you're entitled to this one, the deduction here, even if you are the SSTB.
So again, we talked a while ago about changing from accrual to cash, and you might have a lump sum, multiple $100,000 adjustment to bring down an annual income. This is where it could come into play very dramatically here, because if you can bring down that below 315, it's taxable income, not the adjusted gross income that's at the bottom of page 1. This is after your itemized deductions. Then it makes no difference what you're doing, you still get the eligible deduction.
Mm-hmm.
You can control taxable income really easy versus adjusted gross income.
That's right. General rule, no W-2 limitations here. Generally speaking, you just want to fall in the general rule because it's easy and you're going to get the deduction in most cases if you've got QBI. Looking to decrease taxable income with proactive tax planning. We're going to be touching on that here in a few slides. There's this phase-in deduction. Again, if you are an SSTB, say for example, the IRS comes back and clarifies, no, we're going to rule that a pharmacy is an SSTB. If they do that, and you're in this range here between 315 and 415 married, filing joint, you will still get a partial deduction. You just have to run the numbers in between this range and work with your tax plan models here. Now the limited deduction is limited if your deduction's limited, potentially limited, if your income is over $415,000 married, filing joint. Again, SSTBs are not eligible here. If you're an SSTB, your taxable income's over $415,000, no benefit. The deduction is limited to the greater of 50% of W-2 wages paid by the business, or a sum of 25% of taxpayers' W-2 wages plus 2.5% of the unadjusted basis of all qualified property. What that essentially means is many pharmacies with wages as high as they are in a lot of pharmacies, this limitation will most likely, in a lot of cases, not impact pharmacies in getting that full deduction, full 20% deduction. But of course, there's always other circumstances. Once you've got that deduction, it's then limited on your tax return to taxable income or over the sum of the net capital gains. So if you got capital gains, those have to be taken into consideration as well. All right, some important considerations for 199A. One is, a pharmacist is under the law a service and an SSTB. A pharmacy, we're told, is sale of pharmaceuticals and is not an SSTB. Those are just two issues I want to clarify there. You've got the aggregation rules. So if you own several pharmacies, maybe you own several pharmacies in one entity. There's aggregation rules. There's calculating the QBI on each trade or business. So if you got 6 pharmacies in one entity, you may need to calculate it for each pharmacy there, and determining whether you need to aggregate, whether you should not aggregate. We've talked about the de minimis rule. If you're wondering what W-2 wages to work with or what that means, notice 2018-64 was also released, and it goes into great detail there. The real estate entities, many of them will still qualify for this deduction, although some will not. So you need to make sure you understand the rules there. We're not going to get into that here today. And if you've got losses, qualified business income losses, they may carry forward and reduce future deductions, QBI deductions. So that's kind of a negative there. But this area of tax law is extremely complex, and everything we're talking about here is all moving piece. There's all these different pieces moving here. You got the cash accounting, you've got this, whether you should do this or that, and if I do that, should I do this or that? So there's a lot of moving pieces here, and you just got to do some tax planning to understand what's right for you. Okay, tax planning. You want to take this one?
Yeah, as we've said, tax planning is done now. It's not done in January or February. So these two huge issues we've talked about today, potential accrual to cash and this 199A deduction, require a lot of coordination in currently what you're working with. Now, fundamental accounting is critical to where you are, which is to say, if you don't know where you are, how can you plan? So that's the fundamental aspects of what we do here in this practice, is making sure our pharmacists know where they are on an ongoing basis, keeping in mind that third-party receivables, inventory, and payables and cash have got to be tied in. If they're not, the P&Ls are trash. So you have got to keep that. You need perpetual inventories in place. You need third-party reconciliation systems. You need your checks and balances and controls in place. But you've got to do all of this in order to be in a position to be proactive and to take advantage of these huge planning opportunities for this year. Roll the slide, please. Obviously, go ahead.
The planning process. So you're going to be projecting your gross income. You're going to get an as-is projection. Then you're going to start considering tax strategies to reduce taxable income, retirement plans, etc. Then you're going to be considering how 199 is impacted, what strategies you can implement there, and then you just need to be implementing that plan and staying on top of it. So a couple of the tax planning strategies, we've talked about the accrual to cash. Is likely to increase the expense for 2018 and reduce your taxable income, but is this a smart move for you generally overall? How's it going to impact you in future years? Do you have basis to take any of these losses if you're making losses? A lot of variables here. Financial reporting considerations as well with cash basis financial statements.
You still want to report on accrual basis. If you don't report your numbers internally monthly on accrual basis, you do not know where you stand at all. And this shareholder basis issue is critical, because you may come up with a $400,000 or $500,000 loss, but if you have that amount of basis as a shareholder in a pass-through entity, you can't take that loss.
Right.
And if you don't have a clue what I'm talking about, you need to go to your tax advisor and say, tell me about shareholder basis and tell me about this potential loss situation here if I go from accrual to cash.
Right, and just a quick example, I had a case where we had basis to take a $400,000 loss with the accrual to cash change, and it didn't make sense to do so based on what the taxpayer wanted to do next year. So as you can see, there's no easy answer here. Retirement planning, of course, retirement planning is one of the go-to tax planning opportunities. You're putting away money for retirement. You're reducing taxable income. There's several plans and options available to taxpayers out there beyond just a standard 401k, safe harbor, profit sharing, defined benefit, cash balance plans. These plans, advanced plans, allow you to put away several $1,000s,
Hundreds of thousands of dollars.
hundreds of thousands of dollars in these plans each year, which allow you to reduce that taxable income and save for retirement down the road. So one of the go-to areas when looking for advanced tax planning. Not for everybody. Work with people you know and can trust in this area. These are not easy. Let's just put in a 401k type things. These plans are more advanced.
And be very careful of people who are trying to sell you a retirement plan that are generating commissions from you. That is not who you need to be seeking advice from.
Correct. Conservation easements is a very popular strategy in the market today. So the easement deductions are limited to 50% of your adjusted gross income. They're not 60% of AGI, as we mentioned on one of the first slides here. So essentially, an easement is you invest in a program. That program decides to, as a whole, decides to donate the land to a conservation purpose. That land, that conservation value, as compared to the value of the land fully developed, is your donation. So for example, if you've got a tract of land in the city of Charlotte downtown and you want to conserve it because there's a rare plant on there or whatever it may be, the difference between putting a skyscraper on that block versus keeping a conservation easement, that difference is your donation. You get a percent of that based on your ownership in the program. And as you can tell, that's quite a large difference there. So you get a large bang for your buck in these conservation easement programs in many cases. You do need to work with reputable advisors. There's some people out here who abuse this area of the law. The IRS does not like it because there's people out there abusing it. Work with reputable advisors, people who know what they're doing, people who have experience in this area, and pretty much this is all they do. It is a sound strategy. It's been around for 30 years. Congress loves it. The IRS does not like it. There is an audit risk due to the fact that the IRS doesn't like it, and there are people that abuse this program. So do know that. And the disclosure requirements are excessive in this area as well. And if not handled correctly, the penalties are extreme. Yes. Yep. Okay, we talked about 199A. Not really going to discuss this anymore, but it is a tax planning strategy with your overall plan. So we do not have the example due to our limitations. We will be going over that example at the NCPA show next Saturday at 9:30 a.m. If you're going to be at the NCPA show, we're going to be going over this program again, but we will be going over that detail example.
This is at Boston at the convention.
Yeah, that's correct.
And let me just add this disclaimer. Go back one slide, Scotty. On the disclaimer, what we're talking about here, there are a lot of issues in here that affect what we're talking about. You need to work very carefully with your advisors who hopefully are well educated on this. Thank the Lord we only work with pharmacies, because I can't imagine working with other industries and trying to figure out other industries. This is our niche. We believe we've got it based on what's been issued, both in terms of the law as well as the interpretations to this point. It is ever changing. It is ongoing. Next slide, please. And anything we can do to help you, if you have questions, just call. Say you on the webcast, you got a question about this. We do have a program internally here where we can do what's called an RX assessment. You can go to our website, which is Sykes-CPA.com. We can take a look at your accounting books and records and your last 2 years' returns. We can do a video call with you, go through that. There is a charge for that of $14.95. But we can dissect your accounting books and records and tax returns. And even if you don't retain us to do anything ever, you'll learn more about your pharmacy than you probably ever learned about. But here's our email. Here's our Twitter accounts. Again, there's literally hundreds of hours of videos that we have in the public domain on our website that are constantly being updated every 10 days or so. So please avail yourself to that. And Scotty, let's make sure we've got all these questions here answered. I see AJ's got several here.
Yep.
Make sure you got those.
Yep. AJ, you might just want to reach out to me on these. Not sure I follow you here, so just give me a call on those.
Yeah. But I think we've gotten all the questions answered here. If not, please put any questions in. We can stay on here as long as you would like for us to. With respect to that, again, this webcast will be recorded. We'll put it out on our website, and it'll be pushed out, as Dawn mentioned previously. We will be updating and most likely having further information pushed out on a webcast as conditions warrant. But now, this going into the fourth quarter here next week, this is the time when you need to really work hard to plan. I see there's a question that says pass-through entity. I'm not exactly sure, Alex, what your question is. But yeah, the pass-through entity, I think I know. Yeah, the pass-through entity is the return I would probably show them to convince them to answer your question here. Of course, a lot of what you're talking about there may be city or state specific. And I'm not sure what state you're in, but that could apply there as well. Will the slides be available? We've generally not released the slides. Again, we've just released the webcast. So if you've got the webcast and a recording of that, it'll be pushed out to you. Essentially, you'll have the slides in the webcast. So I guess in a sense, they will be released. Anything else, Scotty, you can think we should add, or any other questions you see need to be answered?
Nope, I think that is it, and we appreciate everybody tuning in today, and please give us a call or email us if you have any questions. We'll be glad to help you anyway.
And if you're in Boston, not only are we doing the session next Saturday, 9:30, we're doing a Selling Your Seminar. We'll be also in the ownership workshop Thursday and Friday, and we'll be exhibiting on the floor. So please come by and see us if you're coming to the NCPA convention. Thanks very much for joining us today.
Thank you.